The most valuable cryptocurrency by market cap, Bitcoin, has fallen by roughly 70% from its peak. Yet some industry insiders remain bullish and believe that Bitcoin will soar once more. One of them is Michael Saylor, the CEO of MicroStrategy, who is optimistic about Bitcoin in light of recent developments in the larger crypto industry. Michael Saylor said that every 4-year time horizon in Bitcoin's history had produced good returns for investors to calm years of declining cryptocurrency prices.
But you know what? That's why we want Bitcoin mining, because there are 100 pretty large Bitcoin mining companies with CEOs and executive teams, and every one of those teams is worried about Bitcoin in Kazakhstan or in Russia or in China or in Canada or in Africa or in Texas or in California or in New York. They're all worrying, and they're worrying so that we don't have to. And ultimately, it is like the skin in your immune system. It's there to catch the infection and protect you. And if you lost your skin, then you would probably not live very long. But occasionally, you're going to suffer a bit, and that's just part of a healthy ecosystem.
When asked if he still thinks that the recent drop in cryptocurrency prices and Bitcoin in particular presented a buying opportunity for investors, Michael Saylor responded that he believes that in the short term, there may be more selling given the state of the market and the economy as a whole. But he is optimistic about Bitcoin in the long run. According to Michael Saylor, a longtime proponent of Bitcoin who has expressed his opinions on the subject, 1 Bitcoin is equal to 1 Bitcoin. This suggests that one shouldn't pay too much attention to short-term price fluctuations. Saylor and MicroStrategy may be facing a potential margin call, which might force the business to liquidate part of its more than 130,000 Bitcoins. But he is sure that no such margin call would be required. The Bitcoin price has repeatedly fallen below $20,000 in recent months, down by about 70% from its all-time high in November 2021. Now, let's hear Michael Saylor talk about these things. But before we listen to Michael Saylor's words, take a moment to hit the like and subscribe button if you haven't done it yet.
Well, I think Bitcoiners forever have been saying not your keys, not your coin. And they say get your Bitcoin off the exchanges. The essential thing that you want to do after you acquire Bitcoin is to store it in a safe place. Now, that safe place isn't always a hardware wallet. It might be an organization like Fidelity that's a custodian that you trust, or some cold storage, or some institutional grade custodian, or a multi-sig arrangement with a company that you vetted and you trust. But leaving Bitcoin on an exchange has always been risky since Mt. Gox, so we all learned that. And I think that borrowing or generating yield from a unregistered or unlicensed bank or an immature bank is a risky thing to do. So, for example, MicroStrategy, we took a loan from Silvergate, but Silvergate was an FDIC insured bank. And when we did that, the terms of the loan were such that we didn't transfer our Bitcoin to Silvergate Bank. We actually put it in custody, and we maintained custody of it. So we could have borrowed money at 0% interest if we had transferred the Bitcoin to one of these wildcat crypto banks, where they would say they give you a very, very cheap loan at a high loan to value, but the catch is you have to transfer your Bitcoin to them, and then they loan it out to a third party.
And before Michael Saylor continues, if you want to support this channel more, you could join our membership program and try our Super Thanks, wherein your comments will be highlighted.
The challenge with that is that you take the counterparty risk with the bank. If the bank fails, then you lose your Bitcoin. And then you also take the counterparty risk with the counterparties of the bank that you don't know of. And so if they loan it to someone else, to a hedge fund, like Three Arrows, and the hedge fund fails, then you also lose your Bitcoin. So you're actually taking two layers of counterparty risk to do business with an immature bank. It always looks good going in. They pay you a higher interest rate or they give you a cheaper loan. But the counterparty risk, when you calculate it, offsets the benefit. That's why we've never done those things. That's why we never generated yield on Bitcoin. And that's why we didn't choose to take on those kind of loans.
Michael Saylor added, "So, I think this is a painful lesson for the industry, but it's not a surprise. I think for the business to grow up, we need more mature, better capitalized institutions, publicly traded companies, public banks, FDIC insured banks, and right licensed registered entities. Of course, when you're doing business, what you want to do is always be careful when it looks too good to be true. Because when it looks too good to be true, generally it is."
What do you think is Bitcoin's biggest vulnerability right now?
I think that right now, the biggest vulnerability to Bitcoin is the rest of the crypto industry. I think the 20,000 tokens that are unregistered securities, I think the crypto exchanges, the wildcat crypto banks, all the crypto projects, all of the people trading those cryptos, all the crypto hedge funds, and then all of the negative publicity and then the negative financial outcomes that come about from things like Terra, Luna, right? The meltdown of a stable coin that was not stable, that was traded as a commodity, that was really a security, that because they never declared it a security, they never actually made any fair disclosures on it. So you had an under-collateralized asset, $50 billion worth of something, trading with $1 billion or $2 billion of equity, right? 50x levered without disclosure, with a lot of DeFi exchanges and other crypto exchanges allowing those tokens to trade and marketing them with leverage. And I think that got cross-collateralized into Bitcoin. And so the volatility of Bitcoin on the upside and the downside, and then the negative publicity and the fear that a conventional investor, an institutional investor would have to buy Bitcoin is in large part due to the Wild West and the wildcatters in the crypto ecosystem. And the sooner that we clear out that leverage, and the sooner that the world starts to distinguish between crypto tokens that are securities and then Bitcoin, which is a commodity, then the sooner the industry grows up and the asset class grows up. The elegance of the Bitcoin protocol is that Bitcoin mining is an open, permissionless industry that anybody can join. And every 2 weeks, the difficulty of mining increases or decreases based upon the market dynamic. So I think of Bitcoin miners as the line of first defense for Bitcoin. When things go badly, either when poor decisions are made or when acts of God take place or acts of government or nation states, the miners suffer so that the Bitcoin holders don't. So do I worry about miners? Sure, if you're a miner in Iran running on free energy, when the government cracks down on the free energy supplement, you'll suffer. If you're a miner in China running on free or cheap electricity, when the government starts to notice that, you'll suffer. So miners will suffer. when electricity costs go up, the miners will suffer. When the Bitcoin price goes up, they'll benefit. Over time, mining is going to get more difficult. It's going to get 18% more difficult every year because of the halvings. And it's going to get 50% more difficult every year because, or 75% more, some percent more because hash rate keeps coming online. And if you're entering the mining business, you're entering into a very, very competitive industry. So that's why I think it's better, if you have money to invest, it's better to invest the money in Bitcoin, not in a Bitcoin mining rig. I think Bitcoin mining is a business and there are counterparty risk. We've seen, for example, you know, if you had mining rigs in Russia, when the Russian sanctions took place, you lost your mining rigs. Okay, so if you're in business, you can have your business interest damaged by war, famine, tariff, tax, competition, entropy, you know, poor execution. And that's why mining Bitcoin is not the same as holding Bitcoin. It's a very competitive, challenging thing. But if miners on the periphery go out of business, if, you know, when half the hash rate got wiped out in China, it didn't damage Bitcoin. It simply shifted the profitability to North America. And if Bitcoin prices get cut in half, and if electricity rates double, it won't wipe out Bitcoin mining. It will simply squeeze out people running mining rigs that are previous to S9. The third generation antiquated mining rigs will find their break-even point reaches 1 or 2 cents, you know, a kilowatt hour. If they can't buy electricity cheaper than a penny a kilowatt hour, they're not going to be profitable, so they'll shut down their hash rate. But when they shut down the hash rate, the difficulty will adjust down in order to balance the network. And the network is probably 1,000 times higher hash rate than it needs to be secure. So I don't really worry one way or the other about Bitcoin. And as for Bitcoin miners, yeah, if I would worry about every one of them. And the reason I don't run a Bitcoin mining company is because it would take all my time and all my attention, and I would be worrying about all of these things.
And that's it. Thank you for watching. If you're new to this channel, please subscribe to be updated for more upcoming videos like this. And if you like these videos, don't forget to hit the like button, or you might want to check out any other videos on this channel. Thank you for watching and see you on the next one.